Welcome to today's webinar. Before we jump into the presentation, my colleague Kay will share some details.
Hi everyone, my name is KO. I'm a paraplanner here at Integris. If this is your first time attending one of our Zoom webinars, I'd like you to know that we love to encourage audience engagement. So on the toolbar at the bottom of your screen, you'll notice a Q&A icon with a speech bubble and a question mark inside. As you have questions throughout the presentation, please feel free to ask Larry these questions by clicking on the icon. And we would actually prefer you use this Q&A button instead of the chat icon to ask the questions, just for the smoothest experience. Larry also loves to see reactions while he's speaking. So if you can do upvotes, hearts, crying faces, or all the emoticons as he is presenting, we would love for you to just jump in and participate. For any questions related to technical difficulties, you can use the chat button instead of the Q&A button, and I will be monitoring questions as we go along and passing them to Larry and Allison. If there are any questions that we don't get to during the webinar, we'll make sure to follow up with you individually after the presentation.
Great.
Larry, go ahead and click over to the next slide, please. Okay, so just a quick disclaimer here. This presentation is intended for educational purposes only and should not be considered tax or investment advice. With that, I'll pass it back to Allison.
All right. Well, welcome and thanks for joining our webinar today with our presenter, Larry Pon. For those who don't know me, I'm Allison Barrientos. I'm an advisor and partner here at Integris. Today, Larry will be helping us discuss the most impactful provisions from the OBBBA to know for individuals, families, and business owners. Larry is a highly respected tax professional with about 40 years of experience helping individuals and businesses navigate complex tax laws. He's a frequent speaker for other tax professionals, professional organizations, and industry conferences. He enjoys sharing knowledge on the latest tax planning and tax preparation topics nationwide. He received his BS in Business Administration from Berkeley and an MS in Taxation from Golden Gate University up in San Francisco. And in addition to teaching income tax at the College of San Mateo, his long list of certifications include a certified public accountant, personal financial specialist, certified financial planner practitioner, enrolled agent, U.S. tax court practitioner, and accredited estate planner. Thanks. Welcome, Larry.
Well, thank you, Allison. So are we all ready to get started now?
I think we are.
Okay, great. Let's talk about the one big, beautiful bill. So what we're going to talk about, we're going to start with how we got here. And then we'll go over the individual provisions first, and then a little bit about the business provisions and introduce the many new tax provisions we have here and talk about what's next. And at the end of the slide deck, I have copies of some of the new forms we have and some of the changes to the tax forms. And of course, most importantly, working with your financial advisor before the end of the year, because many of these changes take place or take into effect in 2025. So more than ever, check your calendar. Make sure you've got your planning session scheduled with your tax advisor and your financial advisor because it's very important. Because if you wait till next year or if you wait till tax time, that's after the fact. We like to be proactive. So let's get started here and talk about the one big, beautiful act. So first of all is how did we get here? Well, we need to go back to December 22nd of 2017. That's when we got the Tax Cut and Jobs Act. And that was one of the biggest tax changes we had. And we've been living under that for the last few years. It took into effect in 2018, and we've been living under that. It took us a while to learn about how to work with it. And then it was expiring on December 31st of 2025 because it was passed under a process called budget reconciliation, which means you only need a simple majority in the Senate. And the House always has a simple majority. Now, the soap opera we saw for the last few weeks was the appropriations bill, which caused us to have a shutdown because you needed 60 votes in the Senate. Well, they kept trying. They kept falling short of 60 votes. And that's why we had the government shutdown, and now they kicked the can to January 31st. So we'll see what happens in January, and let's hope our members of Congress do their job. Well, anyway, because of the tax cut jobs that are expiring, there's a number of bills introduced by many different Congress members. And so they slapped it together into what's called the One Big Beautiful Bill. And the official name is One Big Beautiful Bill Act. And so the law is known as H.R. 1 or Public Law 219-21 because we're in the 219th Congress. And so tax laws start in the House of Representatives and the Ways and Means Committee of the House of Representatives. So the first version of the bill was passed by the House. It started there, went to the Senate, and the Senate passed their version of the law 50-50, with the Vice President casting the tie-breaking vote. Then it went back to the House. So on July 3rd, they passed it with no changes to the Senate version because if they made any changes, it will start all over again. And basically, the way it turned out was all the Democrats voted no. Hakeem Jeffries took advantage of the magic minute. His magic minute lasted 8 hours and 44 minutes. And then two Republicans voted no. And these names you should look out for because you've seen them in the news in the last few weeks with this whole government shutdown. Thomas Massey. Well, Thomas Massey's been in the news more than anybody else. So it's passed by the House of Representatives. We have a law. July 4th was when the president signed the law on the South Lawn at a July 4th party, which we saw a B-2 bomber flyover and fighter jets and fireworks. So we have a law starting effective July 4th of 2025. So let's talk about the provisions in this law. So what happened is that I don't know about you, but I've been having some anxiety for the last couple of years because I didn't know what the 2026 tax rates and brackets were going to be. Are we going to go back to the old law if the tax cut jobs had to expire? So the One Big Beautiful Bill extended the Tax Cut Jobs Act. So my anxiety went down a little bit because I know what the rates are going to be. It's the same rules we had for the last few years. So no higher brackets, no higher rates. So we still have the seven tax brackets that we have, with the top bracket being 37%. So this page shows what it would have looked like if the tax cut jobs had expired. And you notice that brings back the top 39.6% rate and kind of shifted the brackets and the rates around. So we have an update here for 2026. So we know what the 26 rates look like. The Tax Foundation did this nice chart for us. So the top bracket's 37%. You won't hit that until your taxable income is more than 768,000 if you're married, or 640,000 if you're single. But we got these nice lower brackets to take advantage of too, so we can plan accordingly. But the question is, who's going to see a tax increase? Who's going to see a tax decrease? Well, you know what the answer is, right? It depends. Everyone's tax situation is different. Everyone's tax calculation is different because it depends on what kind of income you have. You have earned income? Do you have capital gains? Do you have qualified dividends? What kind of deductions you have? It's a bit complicated. So I'm a tax nerd, so I ran some numbers. You could do this all day long. I just want to see what would happen if the One Big Beautiful Bill did not pass and the Tax on Jobs Act expired. Well, if you're single, it looks like I used the top of the 35% bracket. So I just want to, you can do this all day long. I just used the top of the 35% bracket to see what the difference is. For single, doesn't look like much. Married filing jointly, well, it looks like with the One Big Beautiful Bill, the taxes actually dropped by $20,000. Head of household, it's higher by $3,800. So it's not that simple. So I highly recommend you meet with your advisors to do some projections to see what this looks like. What this looks like. And the good news is our vendors, our software vendors have updated their programs with the new numbers. And we got them. We got them from the IRS just a few weeks ago. And so that's all right here. So the other area of anxiety I had lots of area of anxiety when it comes to tax law, but capital gains was one of them. Are we going to go back to the old rules where it would have been higher? So You pay capital gains taxes if you hold assets for at least a year. So that's another thing we need to do with our planning. If we're going to rebalance our portfolio, if we're going to need to, certain areas are overweight, some areas are probably underweight. We might need to rebalance your portfolio in your taxable accounts. So take a look at which assets you want to sell. Well, if you hold them for less than a year, they'll be taxed at the ordinary rates, which we had in the previous slide. Or if you hold them for more than a year, then you get the 0%, 15%, or 20% capital gains rates. So here's the 2025 rates, and take a look at the 0% rate. This is based on taxable income. So let's look at our married filing jointly people. And if you have up to $96,000 of income, you pay 0% on your capital gains and your qualified dividends. So it's pretty cool. On some tax returns, you might have over 90,000 of income and your tax liability could be zero. So for tax planning, let's see if we can take advantage of the 0% rate. I'm a big fan of paying taxes at 0%. The other one is 15%. That's pretty good. So with the Tax Cut and Jobs Act, and now being extended by the One Big Beautiful Bill, we are in historically low tax rates. So that's something to consider when you're looking at your overall planning. So we're at historically low tax rates. Look at the 15% rate. Look how wide that is. Again, let's look at our married filing joint right in the middle of this page here. Is at 96,000 up to 600,000, and you'll be paying capital gains taxes at 15%, which is a pretty good deal. For your ordinary rates, probably double that. So hopefully you won't be paying taxes at the 20% rate, but you don't focus only on the ordinary taxes and the capital gains taxes. There's also the 3.8% net investment income tax surcharge. So, tax planning is multivariable. So it's not just one number to look at. It's many numbers to look at. And with the one big beautiful bill, there are many more numbers to look at. So we got to be careful and got to put in your tap dancing shoes and dance very carefully among these different provisions. We got an update from the IRS with the inflation adjustments. So the 15% bracket for married filing jointly goes from 98,000 now up to 613,000. And for single, it's 49,000 to 545. So that's pretty high. So for tax planning, now we have certainty. We have certainty about the future rates. So we know what 26, 27, 28 at least, we know what's going to look like. Who knows what's going to happen in 29? Because when you see provisions where I say the word permanent, what does permanent mean? It doesn't mean forever. It means until Congress changes it. So, at least we know there's no expiration date. So some financial and tax planning strategies that we use as Roth conversion planning. So now that we know what the future rates look like, it gives us some certainty in terms of Roth conversion plan. Should we do it this year? Should we do it next year? How much should we do? Take advantage of the 0% capital gains rate. Take a look at your portfolio if you do need to do some rebalancing. If you happen to benefit from the 0% capital gains rate, hey, that's awesome, right? And then strategies that reduce the above the line income. We'll talk a little bit about that more later, but depending on your own personal situation, you got to look at what strategies are available to you. The other big change the Tax Cut and Jobs Act made to our taxes is that it doubled the standard deduction. Well, the One Big Beautiful Bill now makes it permanent because in the last couple of years for tax planning, I was always concerned about, oh no, it's going to drop. That means we'll be itemizing again. But with these high standard deductions, most Americans are not itemizing. You can check in your own situation, but over 90% of Americans take advantage of the standard deduction and they're not itemizing. So we got an update with the One Big Beautiful Bill. This is a little bit higher than what we learned at the end of last year. So Congress bumped it up a little bit. So the standard deductions for singles are 15,750. Married filing jointly, it was 30,000. Now it's 31,500. And just a couple of weeks ago, the IRS announced the 26 standard deduction, 16,100 for single, 32,200 for married filing jointly. So what does this mean? This is the amount of tax-free income you can have. So for example, the first 31,500 of income, if you're married, filing jointly, is tax-free. So what's taxable is the amounts above that. So again, for our overall planning, strategizing, we want to take advantage of this. We don't want to, I never want to waste a 0% tax bracket. We got to take full advantage of it. Maybe we should take a little bit of Roth conversion, still pay zero taxes. That can work out if your income is below the standard deduction. So now it's permanent, but as a reminder, what hasn't changed is under current law, if you're over 65 or blind, 65 or older or blind, you get an extra $1,600 added to your standard deduction. If you're married, that's $3,200 for a husband and wife. Or if you're unmarried, that's an extra $2,000. So something to consider here. So what's new is we have this thing called a senior deduction. It's called the enhanced senior deduction. The only qualification you need is to be 65 or older. 65 or older. And it's $6,000. It starts this year. This year is temporary. It'll expire in 28. So this is above and beyond your standard deduction. And however, there's a phase out based on your income. So if your income is less than 150,000, you'll get the whole $6,000. If you're single, it's $75,000. So this tells us, oh, we got to be careful. If we qualify for this, we need to be careful about taking money out of our IRA or Roth conversion or capital gains or whatever. Because if you go above this income, then it's going to get phased out. Then you might not get to take advantage of it. So senior deduction, $6,000. So what does this mean? Well, one of the big questions we always get from our clients is, Larry, when should I take my Social Security? Should I take it early? Should I take it late? Should I take it on time or whatever, right? And that's a good question. And of course, the answer is going to be it depends. It depends. A lot of factors involved with Social Security claiming strategies. You have married couples. Should one spouse claim it, one spouse not? Should I take advantage of the spousal? Lots of strategies with Social Security planning. What if you haven't started Social Security yet? Well, what if I take it this year, take it next year? Is that going to be enough income to bump me out of the senior deduction? So we don't want that to happen, right? So there could be a reason you might want to delay. And of course, if you take it early, you take a permanent discount. If you take it later, especially after your full retirement age, which is 67 if you're born in 1960 or later, 66 in some months if you're born before that, it goes up 8% a year. And it kind of maxes out at age 70. But if you keep working, your Social Security will keep increasing based on your work record. So, yeah, Social Security is a big financial planning topic. Should I take it? Should I not take it? Or how should I strategize that? The other consideration is required minimum distributions. Again, depending on where you are on your age, and that's a good question. Hey, I qualify for the senior deduction, but if I take my RMD, boom, that's going to kick me out of it or reduce it. So the Secure Act, Secure 2.0, has bumped up the required minimum distribution age. So again, another fun planning consideration to think about. Do I take one required minimum distribution at age 73 and then one at 74? Or do I do zero at age 73, but take the first one by April 1st when I turn 74, and then the second one by December 31st? That means two RMDs at age 74. So something to consider, right? RMD planning is a big, important part of financial planning. Okay, here's a great summary of the standard deductions here. So let's assume taxpayers over 65 and below the thresholds. So look, if you're single, you're over 65, you start at 15,750 plus the $2,000 for being over 65 plus the 6,000 for the senior deduction. That's $23,000 of tax-free income. Let's jump over to our married filing jointly couple. You start at 31,500 plus 3,200 for being over 65 plus $12,000 for a senior deduction. That's 46,700. tax-free income. So, we want to take advantage of those lower brackets and take a look at the plan. Should I take capital gains? Should I take more money out of my IRA? Should I convert it to a Roth? Lots of fun planning. I just really get a kick out of doing this. But this is something to point out that with these new standard deductions, it's pretty high. Well, the other controversial item that we've been hearing a lot of complaints about since the Tax Cut and Jobs Act was passed is that your state and local tax deduction was limited to $10,000. I know we have a lot of unhappy clients about that. One client, he pays $50,000 in property tax, and yeah, he only deduct 10,000. Another client, he owed $3.5 million to California. He wasn't a happy camper. He looked at his Schedule A. He goes, Larry, I paid over $3.5 million to California. How much can I deduct? Well, look at the line there, $10,000. He was not a happy camper. Well, the members of Congress bickered over this. There's a group of Congress members who insists on increasing it. Otherwise, they're going to vote no. So they compromise at $40,000. That's for singles and married filing jointly. 20,000 you file separately. It's temporary though. It starts in 25 and goes up 1% a year. So we know next year is $40,400. Now there's a income limitation here. If your income is up to 500,000, you get the whole 40,000. If your income's above 500,000, if it's above 600,000, you drop back to the $10,000 state and local tax limit. So take a look. I mean, we haven't talked about this in the last few years. I always get this question. It's usually I'm literally. I remember one year I was at a New Year's Eve party and I got a call from a client saying, "Larry, should I prepay my property tax or should I prepay my state estimated tax?" And it's like, why are you calling me? It's 10:30. Come on. So I haven't had that question since the Tax Cut and Jobs Act passed because it didn't matter, right? Because we can only claim 10,000. So take a look at what your state income taxes are, your property taxes are, and maybe you might want to prepay your state income tax before December 31st. You might want to prepay your second installment of your property tax before December 31st. So check with your advisor. See if it makes sense to do that or not. See what the strategy here is in paying your estimated taxes and your property taxes. So this might push people to itemize again. Of course, there are complaints about marriage penalty and all those kind of things. And I see
Hey, Larry.
Maggie, yeah, I see Emily has a question about what's Maggie? Well, Maggie is modified adjusted gross income. And in the tax code, there's references to Maggie all over the place, and they're all different. But in general, it's line 11 of your 1040, which is your adjusted gross income. So in general, and I'll go through that towards the end because I'll show you a calculation of that. So Maggie is modified adjusted gross it's your gross income minus adjustments, not your taxable income, which is a different number. That's after deductions and those kind of things. All right. More planning with this state and local tax deduction. Well, if you have non-grantor trust, let's say you're a grandma or grandma set some trust for her grandkids. And I keep telling clients to stop doing this is to have one trust for four grandkids. Do you know how hard that is to do on a tax? It's very complicated. That's a very complicated tax return. It's also more complicated for your investment advisor too, because the four grandkids are all different. They're different ages, different situations. It makes it a lot trickier for them to how to allocate the portfolio because they might have different cash flow needs. My personal bias is when a client wants to set up a trust for their grandkids or family members, do a trust for each beneficiary because then the investment portfolio will be allocated appropriately for that person for their cash flow needs and all those kind of things. And also from a tax preparation standpoint, it's a lot easier to calculate. I mean, trust returns are hard anyway, but if you do multiple beneficiaries, it's even harder. It's I call it the Rubik's Cube of taxes. So I prefer one trust for each kid. And now that we have this $40,000 state and local tax deduction, we can spread among each trust. It didn't matter before, so I didn't really push it. Now that we have so you can spread over four trusts could be a possibility of $160,000 of SALT deduction because the trust might own a piece of real estate. The trust might be paying California taxes or whatever. Again, talk to your advisor about this. This is really important. All right, what other changes here? This is the where you put the sad emoji, put the sad emoji here. So we have this new charitable contribution floor. Starts in 2026. So what it means is you can only deduct your charitable contributions that exceed 0.5% of your adjusted gross income. Boo, right? Boo. This starts in 26. So here's an example. Let's say your income's on $200,000 and you give $10,000 to charities. Well, 0.5% of $200,000 is $1,000. I gave away 10,000, but I can only deduct 9,000. 10,000 minus 1. Isn't that a big boo? Okay, put some boos here, all right? So, how do we get around this? Make your charitable contributions in 25. And I've been telling all the charities I know about, all the nonprofits I know. It's like send those newsletters, send those emails to your donors, warn them about this floor. And it was snuck in. I mean, I haven't seen this in the news or, there's sometimes they have an article about tax, but they don't talk about this. So we'll talk about more ways of getting around it. Yeah, thank you for the sad face here. So what that means is the stock market's kind of still at a record high, right? Kind of, sort of. So we have some unrealized gains. So perfect opportunity to transfer some of those appreciated securities to a donor advised fund. So it might make some sense. Okay, so we got this charitable contribution floor that kicks in next year. We'll see what happens next year. I think we might not hear a lot of complaining about this until the 27 when people are doing their 26 taxes and they're going to go, wait a minute. Oh, I gave all this money to charity and I'm only deducting this amount? Yeah, yeah.
I actually think that it makes qualified charitable distributions more attractive. Would you agree?
Exactly. I'm a huge fan of that. Huge fan of that. I push that as much as I can. Another limitation is called the itemized deduction limitation. So basically, the bottom line of this change, I'm not going to go through the calculations here. I could spend another half hour doing that, but I'm not. But basically, if you're in the 37% bracket, your deductions are worth 35%. So in this example here, we got $1 million AGI, we got about $100,000 of itemized deductions, but because of this limitation, although I have $100,000 of itemized deductions, I can only deduct $94,000. This kicks in next year. So gotta watch out for that. So yeah. So like Allison was saying, I'm a huge fan of qualified charitable distributions, huge fan of donor advised funds. So with donor advised funds, you transfer your appreciated securities there. I look at my portfolio and I go, ooh, I got a nice capital gain on that one. Instead of selling it, paying a capital gains tax, I donate it. I get a deduction for the value at the time I donate it. And I can give to charities later out of my donor advice fund. So that's great. So front load this year. Yeah, of course, do a meaningful amount. Don't do 10,000. That's not going to make a difference. So do a meaningful amount. I'd say at least 50K. That's just my take there. But if you're 70 and a half or older, you have to be 70 and a half or older. You can donate, make your donations out of your IRA account. Has to go directly from the IRA to the charity. They can issue a check to the charity and give you the check, and then you can give to the charity. But I always recommend get a thank you letter from the charity. Hopefully, a thank you letter says, "Oh, thank you for your donation from your IRA account," and also a copy of the statement or confirmation from the financial institution showing that it went from your IRA account to your charity. Now, the beauty of this, it also fulfills your required minimum distribution. So if you are subject to RMDs, you're 73 or older, do the QCD first. Don't do the RMD first. Do the QC. So work with your advisor on planning your required minimum distributions. Because, I always have debates about this with my friends about when do you take the RMDs? Do you do it early? Do you do it late? Do you do it monthly? Because some people don't want to do this QCD. Larry's answer is after you figure out your taxes, because then I can say, oh, okay, Take your RMD. Oh, withhold this amount for federal, this amount for state. Boom. We use the RMD to pay for your estimated taxes. So the maximum for 2025 is $108,000. We just got the announcement from the IRS that it goes up to $111,000 next year for 26. So you have a married couple, each can donate up to $111,000 out of the IRA, fulfills their RMD. The other benefit is because it's not including your income, it doesn't bump up your Medicare premiums. So that's huge. Also, if you have basis in your IRA, the taxable portion comes out first, which means you keep more of your basis. Huge fan. The other
One
thing,
question that often comes from our clients is whether the 1099s that the custodian sends to the client at the end of the year, indicating the distributions from their IRAs, actually highlights that some of those distributions were qualified charitable distributions. And we always like to remind our clients that right now it does not delineate that. So those must be reported to your accountant separately in order to be removed from taxable income. Now, one thing that's just come from Schwab is that they actually are going to start reporting that in 2026. So that will be a huge benefit on your 1099 in future years.
and we have a new code, code Y in box
Yep.
7 of 1099R. Yay, we finally got our code. But I still, as a tax preparation tip to my preparers, get the documentation because we might get those pesky CP 2000 notices. Another great thing you can do with your QCD is you can do a once in a lifetime rollover out of your IRA to a charitable gift annuity. So the maximum is 54,000 for 25, but it's 55,000 for 26. So I've done this with some clients where, hey, let's if you're going to do the charitable gift annuity, do the maximum, because it's only once in a lifetime. So don't do it 10,000. So whatever the maximum, maybe I'll wait till January. We'll do it in 26 for 55,000. So that would not be taxable, reduces your IRA balance, so reduces your required minimum distribution, and then you'll get a payout from the charitable gift annuity. The payout from the charitable gift annuity is going to be different than the RMD percentage amount. It depends on your age, depends if it's just your life. It could be based on two lives. You can have a successor and all that. I'm a huge fan of that. However, unlike a regular charitable gift annuity, because you can donate to a charitable gift annuity, you can donate cash, you can donate appreciated securities. If you do that, a portion's taxable, a portion's tax-free. If you do appreciated securities, a portion's subject to capital gains tax. But if you do it out of an IRA account, it's all ordinary income. But that's okay. That's okay. So charitable planning is huge for 2025. Highly recommend you put that on the top of the agenda for your planning. And I see Julia's question here. I will address your question when I get to that part of the presentation. All right. Next part is, okay, this is another part where you go, boo. And I don't know which emoji face this is going to be. Gambling, right? And maybe this will help some of our clients stop gambling because they keep losing money, right? So under the current law, I can deduct against my gambling winnings my gambling losses. And that's been the way for beginning of time. We claim it on Schedule 1 of the 1040, so it's above the line, and we deduct it on Schedule A. Now, if it's less than a standard deduction, well, you're not going to get the benefit of it. For one of my clients, I don't know, he's not really a professional gambler, but he usually has about six to $800,000 of winnings every year. But he's got enough losses to offset that. Not a problem. But he quit gambling. I said, "Hey, where's your W-2Gs?" It's because it's an adjusted gross income. It popped into the top bracket for Medicare premiums. So Medicare helped them stop gambling. So thank you, Medicare. Well, maybe this will help too. The new law starting in 26, you can only deduct 90% of your losses. Boo, right? So I was in Las Vegas speaking to tax people in Las. Boy, were they interested in this provision. They were very interested in it. And the one of the Congress members in Nevada, she introduced a bill to repeal this because she says, "Oh, I didn't know about this." Well, most Congress members, they don't read the bill, right? They just vote based on what their party tells them. So she didn't know about this. There's a bill called, I think it's called a Fair Bet Bill to repeal this provision. We'll see where it goes, right? And it's supposed to raise a few $1 billion, so that's why it's in here. And so here's an example. You win 100,000, you lost 100,000. If it was this year, boom, no tax consequence, right? Next year, I lose 100,000, but I can only deduct 90. Oh no. So I win 100, deduct 90. I could pay $10,000 on income I don't have because I lost it. So I don't know if this is going to help people stop gambling. We'll see what happens with this. But this starts next year. Another provision that was snuck in literally at 4 in the morning. Actually, it was 3:36 a.m. was when they snuck this in when they were debating the bill. Yeah, are Congress members sneaky? Yeah, they're sneaky. All right. Julie had a question about the alternative minimum tax. We're in California, so it's a hot topic in California, the alternative minimum tax. Well, guess what? The One Big Beautiful Bill extends the high exemption rate and the phase out threshold. It's permanent. So even though we have a higher SALT deduction, well, look at the single exemptions, 88,000. Look at the married filing joint exemption, 137,000. So if you claim the full 40,000 of state and local tax, that's not going to push you into alternative minimum tax. It's a flat tax, and the only clients I'm worried about with this is our clients who work for a startup company and they have incentive stock options. So we can do what's called break-even planning. How many shares can I exercise before I start paying alternative minimum tax? So I was worried about this for the last couple of years because I thought, oh no, it's going to drop to the really low exemptions we had in the past, which means you'll be our clients with ISOs are going to pay AMT. Well, we can still continue to do this into 26, but it's important if you have incentive stock options, some important tax planning comes into play. Child, oops, did I skip a slide? Yeah, child tax credit has been bumped up from $2,000 to $2,700. So that's kids are worth a couple $100 more now. Um, Regarding student loans, a lot of changes in student loans. One thing to be alert for is the One Big Beautiful Bill takes out a lot of the tax breaks of forgiven student loans. So some forgiven student loans might be subject to tax. So you got to be really careful about that. You got to review them really carefully to see which provision it was forgiven. It could be tax-free. It could be taxable. That's a whole 2-hour seminar right there. However, what's made permanent is that employers can reimburse their employees for their student loan payments. It's up to $5,250, tax-free to the employer, tax-free to the employee, deductible by employer, and starting in 27, it'll be indexed for inflation. So this is a recruiting tool. Company A, here's your salary, blah, blah, blah. Employer B says, same salary, but we're going to help you pay off part of your student loan. Also, the Secure 2.0 Act, adds a provision where the employer can match your student loan payments in your retirement plan because there's concerns that young people weren't contributing to their 401k plans. So employers can match it in the retirement plan um, if you pay off your student loans or whatever. So more things we can do for our younger workers, right? Estate planning, boy, that created a lot of anxiety because we were afraid of the cliff, the sunset, because the tax on jobs had doubled the exemption, went from 5 million to 10 million. So for 25 it's 13,990,000, and then for 26 it's now $15 million, and they'll go up based on inflation. However, I know a lot of clients adjusted their estate plans, assuming there's going to be the cliff or the sunset of the exemption amounts. So you might want to review your estate plans to see if we need to update them. So it's really important. Always review your estate plan to see if we need to update them. But at least now we have some certainty here with the tax rates and all that. But just a reminder, portability of the deceased spouse and use exclusion is still available. So if a married couple, first spouse dies, you might want to consider taking advantage of portability. What that means is the unused exemptions added to the surviving spouse's exemption amount because we have no idea what the future tax law is going to look like. It can drop. There's a possibility it can drop. We don't know. Depends on who's in Congress, who's in the White House. A lot of things can change. Also, lifetime giving is important. The annual exclusion for 25 is $19,000. And the IRS just told us the 26 Annual exclusion, $19,000. So you can give 19,000. You give me 19,000 with no gift tax consequence. But I learned something about this last year. I didn't think about this. Is that if you're going to take advantage of this annual exclusion, make sure the kids cash the checks. Because there was a case last year where this grandpa gave a whole bunch of gift checks, and kids nowadays, I don't know what kids do. They either lose the check or they don't cash it. Well, the kids don't cash it or they lose the check, there's no gift. And if grandpa gives a gift again the next year and they cash both checks in the same year, well, grandpa now has a taxable gift that we need to report on a gift tax return. So, you know, so the tip is give cashier's checks or use Venmo or some way where you can't recall the payment. Make sure the checks get cashed. And don't do it at Christmas, right? That's cutting a little close to the end of the year. Thanksgiving might be okay. All right, 529. I'm not going to recommend this for us. There's been some changes to 529s. There has been changes to 529 plans. But if you're in California, and I think everyone here is in California, right? Well, guess what? California doesn't conform. So they've expanded 529 plans where you can use it for K-12, including homeschool, and also credentialing expenses. But if you take advantages in California, it's taxable and subject to penalty. So not pushing this for our California people. Same thing with this. If you have leftover money in your 520 roller to a Roth, not recommending it for California because that's a disqualified distribution subject to tax and penalty. Lots of great ideas, but you have to see where you are. If you're in California, sorry, can't do it. You could do it, but you pay tax and penalties. Why do that, right? Okay, speaking of charitable contributions, for non-itemizers, we have a partial charitable contribution deduction. So if you're single, you get $1,000. For joint couples, you get $2,000 on top of your standard deduction. But these are cash contributions only. The substantiation rules still apply. So it can't be, oh, Larry, just put me down for 2,000. No, I'm still going to need the thank you letter, the receipts, and canceled checks and all that to prove you did it. I can't just put you down for 2,000. So that's new in the law here. The contribution limit was bumped up to 60% under Tax and Jobs Act. It's made permanent. It's still 60% instead of dropping to 50%. Okay, dependent care. For years, it was $5,000 pre-tax money for daycare and all that. Well, they bumped it up a little bit, $7,500. Okay, for business, we have what's called the pass-through entity deduction, the qualified business income deduction, Y9 cal. It's made permanent. The House bumped it up to 23%, but the Senate brought it back to 20%. It's permanent. And there's a new little minimum deduction if you have a little bit of business income. So that's a little bit of a change here. Um, in California, we got a lot of research and development. This is a big deal. Was it starting in 22? You had to amortize it, which means you can't deduct all your research and development costs. Now you can. And also, it's retroactive to 22, but only if it's done here locally in the US. Overseas, you still have amortized over 15 years. So there are companies are hiring people to do R&D here in the US now because of this deduction. So that's a big deal, especially around where we are. For businesses, bonus depreciation was cut back to 40%. Now we got 100% bonus depreciation for your business equipment for stuff you bought after January 19th. The 179 expensing has been doubled to 2.5 million, so you can write off up to $2.5 million of new equipment. With a new code section, a new deduction, we never had this before. Normally, you have to depreciate a building over 39 years. This is a business building. Well, if you're building a factory, you can take an immediate expensing on it. So that's new. It's called QPP, Qualified Production Property. For businesses, there's a haircut on charitable contributions, just like individuals. I don't know about your situation here, but most of my clients who are corporations are small corporations, one shareholder, a few shareholders. So you can only deduct the amount that exceeds 1% of your corporation's taxable income. Well, for most of my small corporations, I say, why are you donating out of your corporation? Your corporation is taxed at 21%. So your tax benefit's 21%, but you're in the 35% bracket. So why don't you donate personally instead of through your corporation? So that's my tip about this one. Farmland. So if you're selling farmland, there's a new provision that instead of paying taxes all in 1 year, you can spread over 4 years. There is a catch though. It's got to be a farm for the last 10 years. It's got to be a farm for the next 10 years. Ooh, that's a little bit tricky for me. But, there's this new provision here for sales of farm property. And the last sentence here is that uh, the farmer's got to be engaged in farming as defined by the Food Security Act of 1986. I'm not qualified to make that determination, so we'll need an expert to say, yeah, this guy's a farmer. I'm not going to make that determination. We need a person who's an expert on the Food Security Act. Okay, we have this new Trump account. Uh, well, it was Money Accounts for Growth and Advancement. It was MAGA, but now it's called Trump Accounts. Starts July 4th of 26. Starts July 4th of 26. Parents can put up to $5,000 a year in their child's account up to age 18. After 18, the kid can use the money for college, buying a home, or starting a business. And it's taxed at capital gains rate. It's not tax free, but it's taxed at capital gains rate, but maybe they'll be in the 0% capital gains rate. Now, the government's going to put $1,000 into the account if you have a child born, 25 through 28. So the government would automatically do that. The child's got to be a U.S. citizen. At least one parent's got a social security number. And the investments are in mutual funds tracked to a U.S. equity index. It's probably S&P 500, probably similar to Fund C in the TSP plans. So, same thing as that. So it's not invested in bonds or treasuries. So at 18, they can use half the money. 25, they can use the whole amount for those three purposes. At 30, they can do whatever they want with it, but you can leave it there forever. There's a new form. Check out the number of the form. 4547. You get it? I don't have a picture of it. They haven't released the draft of the form yet, so I have no idea what the form looks like, but I know they're being clever with the numbering. Okay, but there's a new employee benefit. So if you're an employer, you can put up to $2,500 per employee's Trump account. I know it doesn't sound fair, right? This guy's got one kid and she's got five kids, but it's 2,500 bucks. So that starts July 4th of next year. And we'll see. We'll get more guidance. It's run by the government. And, again, part of our financial planning, right? For our kids. Do we want a 529? Do we want an UGMA account? Do we want a Trump account? Do we want a Coverdell? The menu choices for investing for our kids. So, of course, it all depends, right? Depends on your situation. I'm going to probably go through the rest of this pretty quick here because it might not apply to a lot of us here. There's a new no tax on tips. So if you have tip income, you can scale up to $25,000. And I'm going to go over the form that has a little more details. And there's AGI limitations too. 150K for singles, 300 for married filing joint. We have the no tax on overtime. 12,005 for singles, 25,000 for married, same AGI limitations. But it's a bit controversial, right? Because it's only for overtime under the Fair Labor Standards Act, Section 7. Now, I'm not a labor lawyer, so I get a lot of questions from practitioners and advisors saying, Larry, does my client qualify? I say, I can't answer that. I would refer it to a labor lawyer. Is that person subject to the Fair Labor Standard? I can't answer that. I only know taxes. My jurisdiction is the Internal Revenue Code, not this other law here. So it's qualified overtime. It's not the overtime. It's the difference between overtime and a regular tax. So this tax season is going to be ugly because employers are not required to calculate this. Us tax guys are, and all my tax people are groaning about this. So here's the calculations. Let's say you're $22 an hour, $33 in overtime. Look at all the math you got to do to figure this out. His overtime is 16,500, but what qualifies for the deduction is 5,500. And let's say he's in a 12% bracket. So the benefit of this deduction is about $660. So I asked my friends, saying, how much are you going to charge to figure this out? There are some practitioners that are telling, Larry, I'm not going to compute this. I'm not going to even claim it. So currently, employers not required to compute it. They will in 26, but not in 25.
Would
And
the most efficient way for a taxpayer to get that information to their accountant be to provide the end of year pay stub?
mhm. And the thing is, it's going to cost more. Okay, it's a lot of work to figure out. And what's confusing is what if my pay rate changes? I started the year at $22 an hour, then I got a raise to $25 an hour,
Mm.
and then whatever. So what doesn't count? And there's a lot of controversy with this, a lot of questions, right? Because who's not covered by the Fair Labor Standards Act? Union workers, shift differentials, bonuses, commissions, right? So we have a lot of questions and we have no guidance yet. So there's a lot of questions bouncing around. No taxes on car loan interest, so up to $10,000 on a U.S. assembled car. It's got to be less than 14,000 pounds. It's got to have at least two wheels. No campers or RVs, only for a new car assembled in the U.S. And so I have a quick case study here. So Andy and Megan, they're married, they're over 60. I made all the numbers work here. His income's 150 grand, so below the threshold. He made 50K in overtime. Megan made 30K in tips from her waitress job. Andy has a midlife crisis, so he bought a car, paid 12 grand of interest. So what's their standard deduction, above the line deduction? So they got I call it the OBBBA bonanza. So they got the standard deduction, 31.5. They got the over 65, 3,200. They got the senior bonus of 12,000. 25,000 for no tax on overtime, 25,000 for no tax on tips, 10,000 for car. Look at this. The first $106,000 of income is tax free versus what it would have been 33,000. And for the kids, they're worth an extra couple $100. This is Andy and Megan, right? You know them. You saw Andy on that kiss cam, right? And so they're not. Andy's no longer married in 26. Well, because of that, he's a tech CEO, and boom, he lost all those benefits. So in 26, he only gets an $18,000 standard deduction. Don't get caught on a kiss cam. Okay. Anyway, sorry, I had to put that in there. So I just talked to a community foundation in Southern California, and she says, Larry, yeah, thank you for the funny emoji. She was going, wow, what's this new credit for contributions for scholarship granting organization, SGO? So if you put money into a scholarship granting organization, you don't just get a tax deduction, you get a tax credit of $1,700. This starts in 27. I got some bad news for you guys here. The state has to participate in this program. California currently does not participate. So there's a political thing behind this. It's has something to do with the school choice movement. So 7 states have it right now, and they're all happen to be red states. California is on top of the list of a state that's never going to adopt this. So I told this lady at the community foundation, I said, do you have any connections with our California legislature? See if they'll do it. And I don't know, right? So I checked with my lobbyists. I'm a member of CalCPA. We have our own lobbyist person. I asked him about it. And also I'm a member of Financial Planning Association. We have a government relations person. So I asked her about it. And they don't have information for us yet. So, so don't count on this. Don't get too excited. But if you are, contact your state legislator, especially if they're a Republican. They're the ones that are going to be sponsoring this bill. Don't expect to see a Democrat. In California, the reason this might not happen is the teachers' unions opposed to it. The California Teachers Union is very politically powerful. Okay, opportunity zones are made permanent. What are opportunity zone investments? It's a great way of deferring your capital gain into another investment. And it could be short term or long term. So we had this with the Tax Cut and Jobs Act. It expires at the end of this year for any new ones. So yeah, if you want to consider it, got to do it before the end of the year. Again, if it's appropriate for your financial situation. So we have a gap year in 26. It starts up again in 27. They kind of changed the definitions. However, if you took advantage of the Opportunity Zone funds, I call it OZ1, it deferred the capital gains taxes to 26. So in your tax planning, make sure we don't forget about including those capital gains on your 26 tax return. That's important. So it's been updated. They'll have a new opportunity zone every 10 years. There's a new qualified rural opportunity fund. So it means if you hold the fund for 5 years, you get a 10% step up in basis. If it's in a rural opportunity fund, you get a 30% increase. If you hold it for 10 years, you get a 100% step up in basis. So again, they're complicated investments. Talk to your advisor, see if it's appropriate to consider. I'm not recommending for everybody. All right. Qualified small business stock just got an upgrade. Three kinds of people you can think about here. Uh, if you are a employee of a startup, you have incentive stock options, that's a possibility. If you're an investor, you invest in hedge funds, venture funds, invest in these small businesses that might go public or get acquired. Or the third one is you're a small business owner, you're an entrepreneur. Your stock might qualify for this. So what has changed is that instead of just holding it for 5 years to get the 100% exclusion, you got this tier here. 50% you hold for 3 years, 75% for 4 years. Also, the capital gains limitation, it goes up from 10 million to 15 million. You can exclude up to $15 million for your capital gains taxes. And the definition of a qualified small business goes up to 75 million. And starts on July 4th of 25. So the old rules still apply to previous ones, but certainly something worth considering here. All right. No more tax credits on cars. It's over. That's in September 30th. However, you got till December 31st to get tax credits on buying insulation, windows, heat pumps, and those kind of things. December 31st. You've seen the commercials, right? On it was a Home Depot and Lowe's. Get your stuff now. The residential clean energy credit, that's the solar panels, the windmill, 30% credit there. Call them now if you want it, because I don't know, the supply chain issue or whatever. So you're probably seeing those commercials too. So you gotta,
And Larry, quick question for you.
yeah.
In order to get some of these credits, is the uh, qualifier that the equipment has to be purchased or that it needs to be installed?
Good question. So uh, the safest thing is have it connected, installed, and all that. And so, dealing with the utility, the permits, and all those kind of things. So start early on it. You can fight with the IRS if I paid for it this year, but the PG&E held me up or whatever. Yeah, you got to get far along the process. Maybe there's one little checkbox that didn't happen. Maybe you can get away with it, but yeah, don't start in January or February next year. That's gonna be too late. Now this is for personal. They do give us till 27 for the commercial ones. If you have a rental property, if you want solar panels and all that, but it's pretty darn tricky. So be really careful about it. Okay, I'm going to go through the rest of the stuff pretty quick because I can't believe how fast time is flying. So I'm going to go through it pretty quick. Health savings account, huge fan of that. Talk to your advisor about it. I think we're past open enrollment maybe, but I always say take a look at the health savings account. It's a HS, S stands for savings. We're all going to have medical expenses in retirement. So great way to get a triple tax benefit. Deduction, it grows tax deferred, and it's tax free if you use it for medical. So the one big beautiful bill added some new features to it. Bronze and catastrophic plans are now HSA qualified. Concierge medical now counts, and also telehealth now counts because we've been pretty good at this telehealth thing. I included the provision that didn't pass because if you talk to your legislator, I would love to see this add it back in. It doesn't seem to cost us that much, but I think it's great. Participate in HSAs, even if you're a Medicare Part A recipient. I think that's a great idea. Fitness expenses, isn't that great? I'm gonna get my gym paid for with my HSA. So I'm leaving it in here with the lines crossed because they got taken out, but I'd love to see that put back in. Last thing is excise tax and remittance transfer. So, we send money to our friends and relatives overseas. There's a new 1% excise tax, but you can get around it as long as it's coming from an exempt source. So, work with a vendor that certifies that so you don't pay that 1% excise tax. That kicks in next year. And I don't know why I'm seeing all these commercials for these remittance companies now. The commercial of the guy with the wife in London. I don't know why that commercial's there, but Anyway, 1% excise tax on that. And then what's next? Well, we finally got past the reconciliation, the budget bill. It kicked the can to January 30th. But tax season, I think, is going to be a bit challenging. So be nice to your tax professional. If you have a great tax professional, hug them close. Don't let them run away, okay? Because we're a scarce breed out there right now.
Yeah, there are a lot of changes to
A
process.
lot of changes to process. I hope, and the thing is, I don't want to be the first tax return. I want to make sure the software is working. So
Yep.
the software vendors use us as their beta testers. So anyway, if you indulge with me for a few minutes here, I'm going to go over some things really quickly here. So we have a new Schedule 1A for these new deductions. So here's Schedule 1A. I think someone had a question about what is Maggie. So here's Maggie. It's basically line 11 of your 1040, your adjusted gross income. There's some adjustments that most of us don't have. It's Puerto Rico income, American Samoa income, foreign earned income exclusion, foreign housing. So lines 2A, 2D for most people are going to be blank. But that's your modified adjusted gross income. Part two is no tax on tips. Now, look at the really important sentence here. If you're married, you have to file jointly if you want to take advantage of this break. And it's for W-2s and 1099s, right? Like I tip my Lyft driver. So I was talking taxes to my Lyft driver. So make sure you print the statement from Lyft. Picture statement of Lyft. Uh, Part three is no tax and overtime. Same thing. If you're married, you have to file jointly. And the form has the calculation here. The um, the thing that befuddles me is line 14B here. Overtime for 1099 NEC or 1099 miscellaneous. But I just learned this from a friend of mine. He's a video guy. And sometimes he has in his contract, if I'm here for more than 8 hours, you got to pay me overtime. He's an independent contractor. I go, oh, okay. But we haven't got instructions for the form yet, so I'm looking forward to that. Part four is no tax on car loan interest. Look at what they need. They want the VIN number. You can't be sharing cars. Part five is enhanced deduction for senior. That's a $6,000 senior deduction. Um, Here's the new 1098 VLI form, Vehicle Loan Interest Statement. I think most of our car loan companies don't have the computers programmed, so we're probably not going to see this year. We'll probably see this next year. 26 W2, 25 W2 looks the same because our vendors can't update the computers, but we've got a couple of new boxes here. So there's some new codes in the W2. TA for employer contributions to a Trump account, cash tips, uh, and then TT, qualified overtime. Schedule A changes are, of course, the SALT deductions bump up to 40,000. Okay, that's the bottom part. No changes there. Look at the new 1040. Lots of new boxes here. Lots of new nosy questions. On the bottom, some nosy questions. Who lived with who? But I want to point out some changes here. On 4A's, IRA distribution. We got 4C now. We got a box for rollovers, rolling money from one IRA to another. And look at box two, it's QCD. For pensions, same thing. We got rollover boxer. We got PSO, public safety officers. So if you're a public safety officer, fireman, firefighter, police officer, sheriff, whatever, the up to $3,000 of your medical insurance is exempt. If you use $3,000 of your pension to pay for medical insurance, it's exempt from tax. So yay! And they're asking more nosy questions on Social Security here. If you're married, filing separately, and lived apart from your spouse for the entire year, check here. Why is that new box there? Medicare premiums. So IRS is asking more nosy questions. The back of the return, we got the line 13B, those additional deductions for line Schedule A. It goes right there. But if you notice on the refund line, no more paper checks. It has to be direct deposit to a bank account. No more paper checks. If you owe, don't mail the check in. Do electronically, either through your tax professional's tax software or on the IRS website. Checks get lost all the time. The next 13 pages are the tipped occupations. the no tax on tips. Um, 13 pages of it. It's kind of entertaining because there's some people I never thought of, like my plumber. I never tip my plumber. He charges too much. Why would I tip my plumber? But anyway, they're on the list here. So these are all the type of occupations and all that stuff. I put it in here for your reference. Also, the last few slides are, I can never remember the effective dates. Oh, Larry, is that 25, 26? I don't know. I don't remember. So I got it summarized here. These are retroactive provisions. Look at the list for 25. Wow. This is effective this year, January 19th, July 4th. Look at 26. All the changes in 26, 27. Again, the phase outs, I can't memorize those, so I got that summarized here, where the phase out ranges on the income levels to get these breaks. And the IRS has a really good FAQ page. One Big Beautiful Act of 2020. The last update was October 24th. I would highly recommend looking at that for guidance and questions and all that. And then if you want to read the bill itself, it's at congress.gov. Oh,
Thank you,
okay.
Larry. And I think it's really valuable. And if any participants would like to see those resource slides in more detail, we'll be happy to share those specific slides as well, because I think that's some really valuable information. Um, in terms of audience Q&A, I think we do have one current question from Brian regarding the question on the slide that you showed where there was a pending bill on no tax on the sale of homes. Do you have any additional context regarding that?
Well, guess who introduced that bill? Marjorie Taylor Greene. She's been in the news lately, hasn't she?
Oh,
So
no.
she introduced that bill because they want to loosen up the real estate market. Because a lot of people, because the exclusion is 500,000 dollars if you're married, 250,000 when you're single. Well, when was that exclusion number put into the law? 1997. So it's not indexed for inflation. And it would be a lot more if it's indexed for inflation, but it can only be changed by an act of Congress. So because of that, most of our clients are paying capital gains taxes on the sale of their homes. So there's a bill there for that. I don't know where it's going to go, but we'll see.
Something to keep an eye on, absolutely.
Exactly.
While you were talking, Larry, one of the things that I did was I wrote down a couple of key points that I thought would be really valuable to summarize and would likely be applicable to most of our listeners. First, this new bill brought certainty around future tax rates and the standard deduction. I think that's a really key and valuable point. There's a new senior deduction up to $6,000 if you have less than $150,000 of AGI and married filing jointly. The SALT deduction got increased to $40,000 for 2025 through 2030.
Mhm.
There is a phase out there at $600,000 for married filing jointly, but that is a really valuable for most of those California clients. Charitable contributions now have a floor if you are itemizing at 0.5% of AGI. If you're not itemizing and you're married, you can get up to $2,000 deduction on those cash contributions. And the estate tax exclusion was made permanent at $15 million, plus future inflation starting in 2026. That's really important for estate tax planning. Is there anything else that we should highlight that would be really kind of universally valuable?
Meet your advisor before the end of the year. I think that's the most
Yep.
important thing. Review your financial situation, read your plans, and see how this all fits in because everyone's situation is different. So just because your friend is doing something, especially social media, oh my goodness. So don't take tax advice from social media. And the IRS reminds of that every year. We get this memo from the IRS saying, please don't take your advice from social media. And here's the ones that are wrong. And they'll be every year they issue what's called the Dirty Dozen. So the top 12 tax scams out there, and they can remind us. And I read that list, I go, oh my God, that's back again. So be careful
Yeah.
about that.
Well, Larry, thank you so much for your time today. We hope that all of you in the audience pulled some valuable insights from our time today. If there are any questions that remain to linger, you can stay online for a few minutes. Larry has generously offered to stay for a few minutes to see if anybody has any specific questions. But Larry, until then, we appreciate your time, expertise, and willingness to break things down into really digestible components. I'm sure that I'm not alone in saying that I'm walking away with a few new gems of information. Take care,
All right.
everybody.